Hello and welcome to Commodity Culture, where our goal is to make you a better investor in the commodities space. My name is Jesse Day. Before we dive in, standard disclaimer, nothing here is investment advice. Do your own due diligence. And today's episode is sponsored by ARC Silver Gold Osmium. They offer personal service and often the lowest price, period, with no minimum purchase for silver, gold, platinum, or osmium. ARC SGO is available to discuss precious metals by email, phone, or in person at their retail location in Jackson, Wyoming, and they are committed to providing the best prices out there and making sure you get the best value and lowest premiums on their wide selection of products. Go to arcsgo.com and contact the owner, Ian Everard, at 307-264-9441 or Ian at arcsgo.com, and make sure to tell him that Commodity Culture sent you. And today's guest is an economist and the publisher of the Gloom, Boom, and Doom report. We're going to be discussing where he's currently seeing value in the market, his concerns about the global economy and financial markets, and much more. It's Marc Faber. Great to have you back on the show.
Well, thank you very much, and good day to your listeners and viewers.
Well, good day to you as well. I'm sure everybody's excited to see you on the channel again. And I wanted to touch on some things in your recently released market commentary. You stated that asset markets are inflated right now, in your view, with a few exceptions. I want to go through those exceptions with you and ask why you're seeing value in them. And I want to start with gold miners. Obviously, quite a divergence between the value of gold itself and the mining stocks. Is that why you're seeing an opportunity there at the moment?
Yes, to some extent. I mean, I have been advocating the ownership of gold for the last 40 years or so. So it's nothing new. And I'm constantly adding to my gold position. I've never sold any gold. I just keep on adding little by little. But the gold price has performed, say, reasonably well compared to the consumer price index over the last 50 years. If we take as a starting point 1971 or 1970, the gold price was at $35 an ounce, and now it's around, say, 2000, okay? Prices of similar of an item whose quality has never changed, say like a Campbell soup. Well, I suppose the quality has gone down somewhat over the last few years because maybe the quality of tomatoes has deteriorated, but it hasn't been subject to a huge technological change. That price hasn't gone up as much as the price of gold. As an example, the price of a house has probably gone up somewhat more than the price of gold, depending where the house was. If the house was in South Africa, probably not. But if the house is in a good location in Los Angeles or in a luxury apartment in Manhattan, then the price has gone up enormously, also rents. But what I want to say is that gold, some people have complained that gold hasn't been such a good investment. Well, it's not the best investment in terms of return because it is relatively safe. That's physical gold held in a safe deposit box or under your mattress at home or in your garden or whatever. On the other hand, gold shares have not only gone down absolutely in the last few years, but enormously relative to the price of gold. Say, I can take the price of gold at 1,000 at the low in 2015, and the price of gold shares at the time, price of gold shares now, and the physical price of gold. And I can say that since 2015, gold shares have either gone down or not up. So the underperformance is incredible. There are reasons for that. Number two, the underperformance of gold shares relative to the S&P 500 is mind-boggling. I mean, that this could happen is incredible. Oil has also underperformed the S&P 500 and value stocks anyway, and emerging markets anyway. But gold shares have underperformed in a spectacular way. And therefore, I think that if I look at the price of gold and the price of gold shares, I think a lot of these shares are relatively low.
And how about oil stocks? This was another asset category you said could present some value at the moment.
Yes, oil stocks, say you take the peak of the oil mania, when everybody was investing in oil and resource stocks instead of tech stocks in 1980. There was a huge bubble in energy stocks. Most prominent among them was Dome Petroleum. Nobody knew what the value would be, but people bought it because it kept on going up. Anyway, at that time, oil and energy combined was about 33% of the S&P 500 index. Now, the energy sector, I've read somewhere that recently Apple alone was worth more than all energy companies in America. Now, as a percent of the S&P, they dropped and are less than 5% of the S&P 500 at the present time. So again, relative underperformance that is colossal. Now, I do agree with some of the views of the environmentalists, and I think we should clean up our environment and so forth. But it doesn't make sense to use an electric vehicle, go to a charging station that is powered by coal generated electricity or by diesel engines at the power station. Doesn't make any sense. So my view is the madness of some of these environmentalists will actually increase the demand for oil, because if you produce windmills and blades for the windmills and so forth and so on, if you go and mine for copper, you need oil to generate the energy to do that. Plus, the global economy now is not performing well. But once the demand for oil increases more in India, because we can look at the per capita consumption of oil, say, in the United States, in China, in Saudi Arabia, and in India. In India, the per capita consumption is about less than 7% of the US per capita consumption. And India is an economy, who knows how far they will grow and so forth. But at the present time, the trend line grows, and I think it can be maintained for a few years, will be around 6-7% per annum. So the oil demand from emerging economies will grow up, will increase. The supply won't go up very much because no new major oil fields have been found, and exploration is very expensive. And technically, at the present time, the commercials sector, in other words, the ones that know about the oil market, they have reduced their short positions and are at a low level that is usually associated with market bottoms for oil.
Very interesting thoughts, and I agree with everything you said. I had Adam Rosenzweig on as well, and he also believes that demand is going to be driven by emerging markets in a big way. I now wanted to pivot to Hong Kong property stocks. This is another asset category you mentioned. I've never actually heard discussed before, so I'd like to get your thoughts there.
I mean, at the present time, if you want to find an asset class which is out of favor, the striking example would be China. 5 years ago, the economist said you have to own this in China and Alibaba and Tencent and Baidu and people were very optimistic about Hong Kong because Hong Kong was the entry into China and so forth. Now, the American media is very biased about everything. Everything that goes bad in the world is because of Putin and because of Xi Jinping in China and the evil Chinese that copy everything from the US. When the Chinese, in the meantime, have developed technologies that are significantly ahead of Western technologies and the infrastructure and so forth. I'm not saying that everything is perfect, but one thing I can say, whereas in 97, when the handover of Hong Kong to China took place, I wrote a small book, The Rise and the Fall of Major Cities in History. And I was very bearish about Hong Kong's, not about Hong Kong, but about the valuations of stocks. And today, this is now more than 25 years, we have stocks that are lower than in 96, 97. So in other words, they're very, very inexpensive relative to their stated book values. We can find in Hong Kong many property stocks, and in Singapore, they sell at 20% of book value. Now, I do not deny that the book value has to be written down, but I have a view that inflation will continue, and in fact, that inflation will accelerate. So the cost of construction will go up, so the existing buildings should be valued at a somewhat higher valuation than they are at present time through the stock market. You understand? In Hong Kong, we have one peculiarity, and major property groups are owned or controlled by families. The families sometimes own these property groups without any debts. Show me in the Western world a company with no debts that is in the property sector. All self-financed. Many buildings in Hong Kong are self-financed. Families own them. They had mortgage loans outstanding, just paid them back because the cash flow was very high. So that is an asset class where both people hate commercial properties and they hate Hong Kong, China. So it's very depressed. I'd also like to say that the other asset class that is worldwide inexpensive are emerging markets. Emerging markets relative to the S&P 500 have had 17 years of underperformance.
Right. So perhaps some big opportunity there as well. You mentioned India. Are there any other emerging markets at the moment specifically that you're seeing opportunity in?
I mentioned India not in the context that I would buy it, because in my view, the market is probably fully valued with few exceptions. It has become a big market and some stocks have lagged behind and so forth. But the markets that strike me as inexpensive are Latin American markets. And in the context of the mining companies, South Africa is depressed and the mining sector is depressed. And then I would say that markets in Asia, Malaysia, Indonesia, Vietnam, Thailand are not extremely cheap, but they are in a so-called buying range. I mean, we could still go down. And I think this is a big issue. If the S&P drops 30% because tech stocks drop, I don't think that other markets will go up a lot. But I think other markets may not go down as much as the S&P. In other words, they may begin to outperform the S&P. Actually, Europe has begun to outperform the S&P in the last 3-4 months.
Fascinating. I want to touch on the Cantillon effect. You mentioned this in your latest monthly market commentary. This is a theory where economist Richard Cantillon said money ripples out from its origin, providing real benefits to those closest to the center. Could you break that down for us and explain how it applies to the economy today?
Who is closest to the center? Do I mean Goldman Sachs? No, I wouldn't think that. But if you print money, I'm not saying that I can explain money printing in 3 minutes fully. But say you print money or you drop money from a helicopter. The money doesn't go to every pocket at the same time. You understand? The Fed, if they want to carry out quantitative easing, what they can do is just go and buy treasury bonds and treasury bills from the marketplace. Now, who holds them? The brokers and the banks and the insurance companies and so forth. So the money flows first into the financial sector, and from the financial sector, it flows into Main Street. So the financial sector gets the money first and benefits them both. So that is what I mean. And we also have to clearly understand. We sit in a room and you have chairs and tables and maybe a kitchen at the background and a washroom, and then you have bookshelves and a bed and so forth. When the money is being thrown into the system, depending on the mood of the public and the recipients and the economic conditions in the room, in theory, all the money could go into one corner of the room. And in that corner of the room, it will generate a huge bubble with prices going up like a rocket. The other three corners of the room will be then relatively depressed. One day, someone will observe that that corner of the room is undesirable because it's so expensive, and the money will flow into one or two or three other corners of the room. What Cantillon basically meant is that prices, and this has been actually observed already by Copernicus, it's not typical original Cantillon. Copernicus observed that already, that the problem of money printing is prices do not go up evenly, but they go up unevenly and with different intensity. And that creates huge winners and huge losers. That is that. And I can say that if I observe, and again, the concept of inflation is difficult to understand, but when prices of butter and prices of cars and prices of necessities go up, it's a symptom of inflation, because another symptom is the price of houses and the prices of stocks and the prices of collectibles and art and so forth. Anyway, when the prices of necessities go up a lot, who gets hurt the most? The people that have salaries that just about cover the necessities. In other words, the lower middle class and the poor people, they get hurt the most through price increases. Someone who has a high income of $10 million a year, he doesn't care whether the price of butter goes up by 10% or 5% or 20%, because he doesn't eat more butter than the poor people. He eats less. He may drink whiskey. That has a different economic background, because it's in some whiskeys are collectibles, then they have a special value and so forth and so on. But it's well known and well documented that in inflationary times, the rich people can make a lot of money, a lot. And there's a concentration of wealth. It has been described in the economics of inflation by Bresciano Turoni. And the middle class and the poor classes lose out. And this is precisely where we are in the global economy. The economy of the super rich is doing well, and of the middle classes, of ordinary people like you and me, and so forth, is not doing all that well.
Well, I think that's a perfect segue into another part of your report where you said that the US and Europe are in a silent depression during which the standard of living of ordinary people declines, although this contraction does not show up in nominal terms. So what led you to this conclusion, and what are its implications for the US and Europe?
There are many factors that I consider, but I look at, say, real incomes. Now, to get to the number of real income, what you do is you take nominal incomes and then you adjust it for the rate of inflation. Now comes the problem. Whose rate of inflation do you take? Because your household's inflation is different than mine, and so forth and so on. And the government, not only in the US, but worldwide, they have a vested interest to understate the cost of living increases. They have all kinds of seasonal adjustments and all kinds of hedonic adjustments and to show that the inflation is relatively low. In my view, and this is a personal observation, I think someone in the Western world at the present time lives with an inflation rate of above 5%. I'd say normal people between 5 and 7%, but in some cases much more. When I look at the increase in insurance premiums that people have to pay, the increase in taxes, indirect taxation, and so forth. And I also look at items. How much does an item cost? Yes, the item may cost the same price, but then the companies reduce the quantity. And I look at these wonderful profits of corporations, have nothing against that. Better the corporations get the money than the government. Unfortunately, the corporations pay the government too much. Anyway, in my view, the typical inflation is 5 to 7% at the present time. The 10 years US Treasury is at around 4%, okay? So the interest rates, although it's gone up over the last 3 years, specifically 2 years, it's still low. When we had that type of inflation we have at the present in the US in the 70s, the 10 years Treasury was around 8% yield. In my view, also, if money was tight, this is the point I was trying to make in my report. If money was tight, the stock market would not be at an all-time high. If money was tight, spreads between junk bonds and treasuries would not be so thin, they'd be wide. If money was tight, volatility index, the VIX index, would be much higher. There are many symptoms that would argue that actually the Fed tells you that they tighten monetary conditions, but in fact, since last October, they eased.
I wonder if you have any thoughts currently about the Russia-Ukraine conflict and the Israel-Hamas conflict. Do you see those expanding and growing, and what do you see the implications being for the global economy and financial markets?
I think you want to get me hated by your viewers. because I have a much more favorable view of Mr. Putin than the Western media and the employees, the warmongers in the State Department of the United States. I can't believe that ordinary Americans want to have a war with Russia. For what? What do they hope? This whole media paintings that he's an evil man, that he wants to take over Europe. Russia has no way in a million years to take over Russia. But if Europe and NATO, under the leadership of the US, NATO is essentially US-centered organization, if they attack Russia, Russia will strike back with, and they are right about this, to do so, if they are attacked. Now, the Ukraine war can be solved because the eastern Ukraine part is ethnically Russian. That we could split apart and give to Russia. And Western Ukraine, including Kiev, could be Ukraine and stay Ukraine, but it shouldn't join NATO. That, I think, will be a condition, that it will be sort of a neutral zone. But we had such an agreement to some extent that was then made, that was concluded in 2014. But of course, the US, CIA, and special troops and so forth went and trained Ukrainian soldiers, and then you know, the warmongers will not shy away from anything, from any sacrifice that can lead to a war. They wanted war in the Middle East. They wanted to destabilize the Middle East. They got it.
Right. And do you see that conflict heating up as well in the Middle East? Do you see a US-Iran conflict being inevitable at this point?
Well, whereas I think that through negotiation between, say, people with common sense, not people who don't want peace, but people who say the horrors of war are such, we have to find an agreement and terminate this war, and we have to make compromises. That, I think, is the advantage of Ukraine, that it's a conflict that could be solved easily. More difficult is the Middle Eastern situation, because I don't think that this is just a conflict between Hamas and Israel and the Palestinian and Israel. The solution would be a two-state solution. But as you know, some people don't want that, not at all. And they want war, and other people also want war, and other people are fighting back and so forth. So it can become very messy. But in general, I'd like to say this. In the Western world, in general, the consensus is in favor of Israel, that yes, they made some mistakes when they occupied Gaza and so forth, but they toned down their aggression. But in the rest of the world, and the rest of the world is, say, around 85% of the world's population, this Israel-Hamas conflict is a disastrous public relation exercise for Israel, completely destructive. I mean, terrible, because here it shows that the people that kept on complaining about the Holocaust and so forth themselves are not much better.
Very interesting
And I'm not
thoughts.
condemning the Jewish population
Right.
in general, but the Zionists, the extremists, these people I do condemn. And I also condemn Netanyahu, because he really didn't seek a reasonable solution.
Now, do you
And I
think
mean, it's a horrible scenario. I can tell you, if you look at some of the pictures and some of the documentaries, they're not shown in American TV, I guarantee you. But elsewhere, then it's not a pretty picture.
Do you think with all of this global conflict, geopolitical shifts that we're seeing in the world, do you think it's important for people to be geographically diversified? And I mean both potentially in investment portfolios, as you spoke about with emerging markets, Hong Kong property stocks, opportunities outside of the Western world, and as well as potentially in their residences and their ability to move around the world in case things heat up in certain areas, or we're obviously seeing a move towards authoritarianism in the Western world as well. So I'd like to get your take there.
I've been thinking about this a lot. I think it's important for people to have, and I'm again saying, some people with money have some privileges that others don't have. Because if you are working, and you asked me actually before, what are the symptoms that ordinary people struggle? Paycheck to paycheck living conditions is a sign of you don't get the salary that cover your living expenses. But anyway, if you have money, I think a safer place to live than in a big city. And we've seen also now the WHO, they want to kind of introduce legislation where they could say to countries or demand from countries, you have to vaccinate the whole population. And we know what the results are. So anyway, my point is you should try to live in a small village somewhere or a small town, but not in huge centers where you have 10, 20 million people living, because there food riots could occur and you can switch off the energy of all the people. You can switch off the light. You can switch off internet connections. How you're going to go and shopping? If you live in a small village, it's a community life. You understand? It's a totally different lifestyle. But of course, you shouldn't go and live in a small village as Mr. Rich Guy with Cadillacs and Rolls Royces and private planes. You should go and live as an ordinary citizen. And that you can do in Europe and, in the Caribbean and in Latin America. I think geopolitically seen, we talked about Latin America very briefly when we discussed emerging economies. I think Latin America, in a world war confrontation, which would be essentially between the partnership, Russia, China, the US, Europe, Middle East, who knows where they would be. I think that Latin America would be a relatively safe option. And then you have also options about, Africa is a beautiful continent, but it's not very safe for families. But say if you live in Thailand, it's relatively safe. Accidents also happen here, but it's relatively safe.
Right. That's makes a lot of sense to me. Living in a smaller community, building that community so you have people you can trust when it comes to a situation where food is scarce. You've got the people there potentially producing food, farmers, etc., and the ability to access that food as opposed to going to a massive supermarket chain and everybody's panicking.
Yeah,
So
sure. The safest is Sicily.
Sicily, interesting. Yeah. I mean,
And you
I'm
know
in.
who's at the origin of the fabulous organization. And also Japan would be very safe.
Right. Yes. Yes. I was just in Japan. Lovely country, although they definitely have issues economically, with their debt to GDP. Maybe I'll shift there for a moment. How do you see that playing out? Because that's an interesting thought. I've thought about Japan as well. I'm located in Serbia now. I've thought about, having a residence in Japan at some point too, but I have concerns about their massive debt to GDP, obviously highest in the world. Um, do you think there is potential for an economic collapse in that country, a collapse of the yen, hyperinflation, this sort of scenario, or is that sort of thought kind of hyperbole?
We already had quite a significant decline in the yen. And if they keep interest rates at zero and inflation accelerates, then obviously the currency will go down. I think they're in a mess. But you have to say also to yourself, the Japanese is a very unusual society in terms of discipline and patience and politeness and consideration for other people. I mean, if the lights go out in New York, you can't imagine what kind of looting would go on. The shops
Yes.
would be empty in 10 minutes. But if the lights go out in Japan, they will use candles and help each other.
Yeah, that's a very
This
good
is
point.
Japanese society. Is a different frame of mind. Is a mind of the samurai. Self-sacrifice is very important in Asian philosophy.
That's very true. Now, I want to end on this. Our goal on the show here is to make viewers better investors in the commodity space and just better investors in general. So I'm wondering, to that end, are there any words of wisdom you could leave us with?
I think the time is now good to enter commodity-related stocks. They're very depressed. I think they may go down another 20%. But my nightmare scenario is that financial assets go down 80%, not just 20%. So I think the commodity space is relatively interesting. Number two, within commodities, we have some commodities that are relatively expensive. I would say that, as I explained earlier on, gold is relatively high. I'm still buying gold, but I think it's relatively high. But agricultural commodities are now extremely depressed. They are now at the level relative to the commodities index and relative to the consumer price index that is extremely depressed. So I think that it wouldn't be a bad idea to buy rural properties and to buy companies that would benefit from an increase in the price of wheat, corn, bean, and soybeans. Say countries that would benefit from it would be Latin American companies or countries.
Well, Marc, it's been an incredible conversation as always.
Well, I'm not sure.
It was. Learned a ton. Always love talking to you. And for those who want to learn more and hear more from you, tell us about the Gloom, Boom, and Doom report and where people can find that.
We have a website, Gloom, Boom, Doom, all in one word, gloomboomdoom.com. And there the investors can choose the report more oriented towards near-term movements in markets and so forth. And my Gloom, Boom, and Doom report, the other report, is some historical observations and philosophical observations and geographical observations and so forth. But of course, both or highlight essentially the same sectors or the same stocks or the same countries. It's not that in one report I say buy and the other report I say sell.
Right. Well, great. I'll put a link in the description below to
Well, it's very kind of you.
gloomboomdoom.com. Yeah. And thank you so much again, Marc, for coming on the show, and looking forward to the next time we speak again.
Yes, I hope I can visit you one day in Serbia.
Yeah, that would be awesome. I want to visit Thailand someday too, so we'll have to get
Great.
together.
Yes, sure.
And thank you for joining us today. As a reminder, this episode is brought to you by ARC Silver Gold Osmium. Go to arcsgo.com and contact them at 307-264-9441 or by email at ian@arcsgo.com to get the best prices out there on precious metals. And I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.